we are going to see nominal GDP run at levels that we have not seen in decades. I think as you look 2 years out, I could see 4, 5, 6 handles like we haven't seen in ages. Do not be surprised after this initial short-term weakness or spike in yields that we get a bid in treasuries following the inauguration, and that lasts for some time. So these are some things that people are not expecting. And like we say in the business, the first move is often the wrong move.
Thomas Hayes, managing member of Great Hill Capital, returns to the show. We'll be breaking down his analysis of the economy, the markets, and what's happening with the markets into the new year. Welcome back to the show, Thomas. Congratulations on yet another good call. You've been right on the rally, and it looks like the rally is sustained up until now. A bit of a pullback today on Friday. 1.29% drop on the S&P 500 as of noon Eastern time. The Nasdaq's down 2%. So this week's looking like a losing week, Thomas. We'll talk about that. Welcome back.
Thank you. Thanks for having me, David. Great to be here.
So losing week. It feels like, of course, we're short-term focused. This has only been a couple days since Trump won, but it looks like the Trump euphoria has been fading this week. Was it just a short-term fade, short-term trade? What happened here?
Yeah, I think the initial reaction was a lot of people were offsides into the election and had to chase up. And then this is a consolidation of the gains that we saw. If you look at seasonality since 1932, if you look at the roadmap, this is pretty normal into about the third week after that initial pop off the election, that relief rally, that kind of certainty, the uncertainty clearing type of rally. You do get some weakness into late October around the third and a half week. And then you tend to persist with strength year-end rally into the inauguration. Now, we got something for everyone here for those people who don't love Trump. Well, the first 6 months after the inauguration after an election, it tends to be sideways to a grind down. For those who love Trump, you get that rally into the inauguration, 6 months of sideways, and then the second half of the year tends to be a very strong rally in that first year of a presidential cycle. But the good news or bad news, depending how you look at it, is that's the average since 1932, whether you have a Democrat or a Republican in power. So I think what's going to be new here, David, is what is perceived to work under the new Trump administration and what has actually worked under the previous Trump administration, if you want to go into some of that.
Well, is there anything he's proposing that's dramatically new in its respect to how it may impact the markets?
Well, people think the 60% tariffs with China is new. This is what he ran on in 2016. And interestingly enough, the minute after he was elected in 2016, what you saw, there was some weakness of emerging markets and Chinese stocks into the election. I don't know that was predicting a Trump win in 2016. Very few people were, but that weakness persisted into the inauguration. So the months of November and the months of December in 2016, emerging markets were weak, China was weak, China tech was weak. And then following the inauguration, we had one of the biggest rallies in the shortest amount of time in history in emerging markets, in China tech, in Chinese equities, despite him running on protectionist tariffs and being the tariff king. So I think the surprise for 2025 will be that these stocks start to do exceptionally well after the election, despite the consensus that they will remain weak, and they're weak into the inauguration on the basis that tariffs are coming. The other thing that's happening, David, that we're seeing right now that we saw in 2016 as well, is the US dollar rallied like crazy on the election into the inauguration and then completely rolled over the following 6 months. You had a weakening like you hadn't seen in a long time from January 2017 through the summer of 2017. And then the final one that's going to be the shocker is everyone thinks yields are going to blow out because Trump is going to deficit spend and he's going to lower taxes. And the exact same thing happened in 2016. He was elected in November. Yields blew out until the inauguration. And then you saw a big reversal. Bonds started to get bid. Yields compressed the entire first year of the presidency. And basically the 10-year yield during that time, this set of circumstances will be slightly different, was between 1.29 and 3.2, if you can imagine, during his presidency. But certainly this time the range will be higher. But do not be surprised after this initial short-term weakness or spike in yields that we get a bid in treasuries following the inauguration, and that lasts for some time. So these are some things that people are not expecting. And like we say in the business, the first move is often the wrong move.
Before we continue with the video, let me tell you about a growing threat and risk to your personal safety that you should be aware of. Over the last decade, politically motivated online threats have surged, especially around recent election cycles. With the conclusion of the 2024 presidential election, concerns around personal information exposure remain critical. Today, 3 in 4 voters fear political violence fueled by how easily personal information like phone numbers, home addresses, etc., can still be found online. That's where today's sponsor, Delete Me, comes in. Delete Me removes your personal information from hundreds of data broker websites, helping you stay safer online. Using Delete Me is simple. Submit your personal information for removal, and within 7 days, you'll receive a privacy report showing where your data was found and removed. Delete Me continues to monitor and remove your information throughout the year, keeping you protected long-term. For 20% off all U.S. consumer plans, go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout, or scan the QR code on the screen to get started. Link also down below. Take control of your online privacy with Delete Me today. The first move is often the wrong move. Well, let's break down these asset classes that we've talked about. So starting with the last one, yields. So you're right. Let me just pull up my screen here. We can take a look at exactly what happened in 2017. This is the chart of the U.S. 10-year yield. Trump's last inauguration, January 2017, was here. Yields had a blowout, like you said, went down, and then went back up. Now, I wonder how much of this decline from 18 to 20, basically 2018 to 20, was a result of the tariffs. People just offloading on U.S. dollar and offloading on treasury assets. Here we go, 2018, 20. This is the U.S. dollar here. So similar decline. They followed each other. U.S. dollar, the 10-year yield. Was this a result of an escalation of tariffs with China, or was this a result of just the bond market reacting to other forces here?
Yeah, I mean, it can always be a combination, but the key thing is he ran. There was not a surprise here in that he ran on tariffs, and the market was expecting tariffs. So the market is a discounting mechanism and tends to act much before it actually happens. So he had been talking about it since 2016. And I think you got me looking at here, January
2017, and this is March 18th.
Yes. Yeah, so that's exactly what we're talking about here. You saw a spike in the dollar and then weakness in the dollar following the inauguration. And I think if you look at commercial positioning right now, David, I think I was on your show in October of 2023 when everyone was selling bonds in the hole, yields were out, and I was saying, buy bonds, buy bonds, buy bonds. And we had a rip your face off rally that lasted for over a year.
Okay, so given your outlook on the Fed funds rate, what's your outlook for the short term and long term of the yield curve?
Well, I think the biggest surprise for the second half of this year, and where all of my focus is on, is that there is going to be an unexpected rally in the 10-year bond. If you look at the commitments of traders, which is an important measure that we look at very carefully, it works differently for different instruments. But when it comes to 10-year bonds, you can look and see that the commercials have been aggressively getting long for the last couple of months. They always are early and they always are right. I think in the back half of the year, what no one's expecting is that the 10-year is going to get bid. And that's going to have a huge impact on this rotation moving forward. The two key themes for the second half of this year, in our view, are U.S. dollar continues to be soft and weaken. And number two is the 10-year bond gets bid, which compresses yields which has a positive impact in terms of mortgages, in terms of banks, in terms of REITs, and in terms of the rotation into small caps, which the largest sector, of course, 21%, is financials and small banks. Right now, commercial positioning is at an even more extreme level than that, i.e., large traders and hedge funds are the most short that they've been since 2018, I think it was, before we had a rally. The last time that you had hedge funds and large traders this short, let me know when you pull up bonds. You got the dollar up.
So you're looking at 2018. Yeah, that's
the
yields
dollar.
started falling in October 2018. Yeah.
Yeah. So you have an exact same situation right now. Commercials are aggressively long treasuries, meaning they expect yields to come in. Hedge funds and large traders are shorting in the hole. So this is consistent with what we saw in 2016 after the election and before the inauguration. Yields blew out and then they came back in. Same thing. Dollar straight up and then weakened after the inauguration. So I think the theme is, regardless of the noise in the short term, bonds will get bid in 2025. Dollar will weaken and resume its weakening trend again in 2025. And that's going to be helpful for emerging markets and ex-US, despite the current sentiment, which is US exceptionalism, everything in the US with the Trump trade. It just simply didn't bear out that way from 2017 through 2020, albeit the economy did exceptionally well in the US, but not at the expense. It wasn't an either or, it was a both and.
So this was a massive move back in the last Trump presidency. From November 2018, the 10-year went from 3.26 all the way down to about 0.5. Yeah. But about like almost a 300 basis point drop over the course of 2 years.
Yeah, and no one would have predicted that whatsoever, and that's what we're talking about. I'll tell you another shock. If you can pull up XES, which is oil servicers. Okay, so everyone thinks drill baby drill. Yeah. These are going to be the greatest trade of all time. And so you had that huge spike into the inauguration after the election, and then it was the greatest short of all time. If you had shorted energy, oil and gas servicers from the inauguration over the next 2 years, you made a fortune under the Trump administration. 90%. Yeah. So even if you pull...
what was the WTI doing during the same period? I'm curious. Okay, so this oil didn't actually underperform to the same extent, except that big... the COVID was a one-off, right? This went from like basically whatever it was to zero, but okay.
Pull up XLE, pull up the integrateds. You would think that they would be less hurt, not after the inauguration.
What happened to the miners or the oil companies?
Yeah, basically, you had more supply, you had more subdued prices than you had historically had, which hurt margins, which helped the country, which helped inflation be lower, helped business, helped real incomes, but didn't help the energy companies because they work on margin, and their cost of production was higher than it is today, and the price of oil was also a lot lower. So that's not a formula to generate a lot of cash. The other one that was a big shock is look at XRT retail, also spiked on the expectation of a strong consumer after the election. And then as you got to the inauguration, right there in January 2017, you had weakness for the next year.
Mm-hmm. Yeah, that's what happened. So 2016, 2017, inauguration was January 2017, and then it basically went down 12% into the trough. Well, okay, so a couple of things may be different this time. So we're in a rate cutting cycle. During the first couple of months of Trump's presidency, that did not happen. The Fed was not cutting rates in early 2017, I believe. Well, let's just double check that. So here's the effective Fed funds rate, 2018. Yeah, actually, they were in a tightening cycle the other way around. So that's one major difference. The other major difference is I'll let you evaluate this, but people have been calling for a recession. It may just be a moot point. Maybe it never happens. We'll see. I'll let you respond to that. And then the third thing is taxes. It's been speculated he might be even more aggressive with tax cuts this time around. So three things: monetary policy. The second thing is whether or not we're getting a recession. There was no recession in 2017, 2018. And then number three, taxes. How do these forces impact the general markets?
Okay, so monetary policy, pull up XLU and XLV. XLU first, which is interest rate sensitive, it's utilities.
Yeah.
Everyone would think this would be a train wreck under Trump. And what did you see? You saw weakness after the election, and then after the inauguration, complete rally for the next year.
Yeah.
Okay. So this is consistent with bonds getting bid, dollar weakening, all of that stuff after the inauguration. So as it relates to monetary policy, that will be supportive for yields lower. It will be supportive for dollar weaker. However, I do think the terminal rate, and we've said this a bit on your show, we believe this was a mid-cycle adjustment. We think there's many more years in this bull market. And therefore, the terminal rate is probably going to be a lot higher than most people had anticipated. Most people were looking for 3%. We've been kind of the lone voice saying it's probably going to be more like 4%, because if you look back to 95, which was a mid-cycle correction, and some other mid-cycle corrections in the late 60s, they didn't have to go more than about 150 basis points to get to an acceptable non-restrictive stance. And I think that's going to be the case this time as well. XLV is healthcare, same thing. Everyone's selling it off today on the basis of RFK Jr. taking over, and some expectation that no one's ever going to take medicine or a vaccine again.
Yeah, I didn't see that. It's a 10% drop in the last 2 days.
Yeah. So if you go back to 2016, you'll see it did the same thing after the election and before the inauguration. Weakness and then strength for the next year. You got to go further up. There you go. Yeah, November.
Yeah.
November, straight down into the inauguration of January 2017. No, yeah, now you're there.
Okay.
Yeah, now to January 2017, and then after the inauguration, straight up.
Right.
So again, all of these things, you know what else did the same thing? Believe it or not, ARK, ARKK, the thing that is absolutely blown up. She could rise like a phoenix from the ashes here in this environment. As bonds get bid, yields go down. So she had weakness after the election, and then straight up for the next year plus. So you said monetary policy. You said cutting the taxes. This is an enormous deal. This is the white swan that people aren't putting enough emphasis on. With the sweep, which was only confirmed basically 24, 48 hours ago, even though it was pointing in the direction. If you take the tax rate from 21% down to 15%, your tax expense is reduced by about 29%, which would imply in the short term, earnings estimates are too low at 275, and they should be re-rated over $300 per share on the basis of just that tax benefit. Then if you apply the multiplier effect of the reinvested capital over the next couple of years, you start to look towards 325, 350, and no one has that in their numbers right now. So I think that people are underestimating earnings power, earnings growth, earnings broadening under the Trump administration, and that now that you have a sweep, the 15% corporate tax rate is almost a foregone conclusion. And that's going to have a material impact. That would never in a million years pass if the Democrats held on to the House. So that is an underrated white swan event as it relates to earnings, and makes the market, which seems like it's pricey right now, start to look a lot more reasonable if you add back the re-rating of earnings.
Okay, so the last couple of jobs reports were pretty positive. We're working with the assumption that this data is pointing towards a soft landing. I think a lot of people, even on my show, have kind of given up the recession narrative. Where do you stand? I bring that up because, as I said earlier, in 2017, Trump wasn't facing a recession prospect.
Yeah. So I think we've covered this on your show in 2023. And basically, everyone was waiting for the recession. And I got on your show and I said, no, this October 2023, this is a buy opportunity because the recession that everyone's waiting for already happened. And if you look back to Q1 and Q2 2023, you had 2 quarters of negative GDP growth. That is a technical recession. The government never acknowledged that it was a recession, but that is the definition of a technical recession. So the recession that everyone's waiting for has already happened. And usually you get a recession once every 4.5 years. The problem is we had one in 2020, and then we had a second one in 2022. First 2 quarters of 2022, excuse me. First 2 quarters of negative GDP growth. And so you basically had 8.2 years of recessions in 2-year period, which is why you could go a handful of years without another recession. It was just pulled forward. And I think that's what people are missing now. So soft landing, no, hard landing. How about no landing? How about we just hit an earnings trough in Q3 of 2024, and we're going to start re-accelerating earnings growth led by the unmagnificent 493 over the Magnificent Seven. Magnificent Seven earnings growth has decelerated from the first quarter of 2024 at 50% earnings growth to now in the mid-teens earnings growth. That's going to continue to stay in the mid to low teens. Unmagnificent 493 has had negative earnings growth in Q1 and Q2, just inflected positive, and will start to re-accelerate into the low teens earnings growth in 2025. So that broadening is going to be a general sense of well-being, growth, and excitement in the economy, not just a handful of companies driving the bus.
Okay, you brought up ARK, so let me just bring up tech stocks since ARK is kind of tech heavy still. So this is the Nasdaq Composite, January 2017 to its peak in October 18, up 48%. I'm curious what the Russell did during that same time period here. 2017 January all the way up to the peak, 25%. So the Russell actually underperformed the Nasdaq during the same period. Okay, your view on tech stocks overall? Because I know you brought up ARK. Tesla shot up to the moon in recent weeks. Mainly because of Elon Musk's association with the administration now. But this is what happened with Tesla. It went up about 40% in a matter of a week. I don't know if that had to do with the fundamentals of tech stocks or more to do with politics, but I'll let you address this.
Yeah, I think this is going to be a surprise for a lot of people, whether you look at ARK or FFTY, which is the IBD 50 Momo stocks during that period, or XLK, or even SMH for semiconductors. They all did exceptionally well under Trump. So small caps also did well, but they pulled forward a lot of the gains in those 2 months right after the election. If you look at it, it was that huge rally off the November lows, and then it consolidated for that 6 months before resuming higher. So I think that's the surprise, and that's what I'm trying to emphasize. People think, oh, it's only an energy and industrials game and banks game, but actually energy was a short of a lifetime in the Trump administration after the inauguration, and tech did well, ARK did well, semis did well, equal weighted, small caps did well. China, you know what else did much better under Trump than under Biden? Pull up TAN, solar stocks. Okay, this is not my neck of the woods, but if we're just being objective, take a look at what happened from 2017 to 2020.
Wow.
And
then 90%, yeah.
Yeah, and then if you look at the Biden administration from 2021 through 2024, not no bueno. And this is another misconception people will have going into the Trump administration, thinking they know what's going to work under Trump. And it's, for the most part, the exact opposite of what they're expecting. Now, industrials did well, staples did well, discretionary did well, financials did well. Most things did well. The two things that stand out that didn't do well, which is surprising, is energy and retail stocks. XRT, you can pull that up. And biotech did well. By the way, biotech did well. So
I was
Healthcare
going
did
to say
well.
it looked like a lot of defensive sectors did well, but it wasn't just defensive. I mean, some of these things you're pointing out to aren't defensive at all. But yeah, okay, up 20%. I think the wild card I wanted to address with you is we talked about tariffs, but the escalation of trade wars in general and more protectionism, would it force China and some other competing nations to uh, I would say buy less of American goods, tech. Right, China has, in the last 4 year cycles, they've greatly advanced their own tech sector. They don't need the argument is they don't need Apple or American chips anymore. They can just make their own.
Yeah, look, I think the conversation is going to go something like this. Mr. Xi Jinping, you're taxing us massively on everything that we put into your country. We're going to just match it. So we're going to start at 60%. We can go, if you want to tit for tat and go up to 100%, we'll go up to 100% too. If you want to go down to 30%, we'll go down to 30%. Oh, and by the way, Mr. Xi Jinping, if you want to have zero, we'll do zero as well. How does that sound? And that's basically how the conversation is going to go. So my guess is Xi Jinping is initially not going to want to negotiate. So Trump will just match him where he is, which will look like 60%. If you look at all the objective data out there, what it shows is if in fact Trump initiated a 60% tariff on all Chinese goods, it would hurt Chinese GDP by 2 full percentage points. So it would move from 5% down to 3%, which is still in line or slightly better than the US is doing right now. So bad news for China, but not devastating news for China. Because when I first heard 60%, like everyone else, I thought, wow, that would put them in a Great Depression. They would be down, their GDP would be negative 5%. It would be, a train wreck. It's simply not the case. They become more consumption driven, more internally driven. So I think the beauty of the Trump administration and why Chinese stocks did so well after the Trump inauguration in 2016 to 2018 is because Trump is not an ideologue. It's not we have to start a Cold War with China just because their economy is growing. It's let's get a deal done that benefits Americans. Americans first. We want to create jobs in America, but we got to do a deal. And it's not about creating the next Cold War. It's about just getting more money for Americans. And I think that's a different framework than the previous administration had, which was China's bad, period. No need to talk. They're our enemy. They're our threat. And I think Trump just wants to do business.
I just want to talk about retail one more time since you brought up XRT. So January 2017, in the months following the last inauguration of Trump, the XRT went down about 14% to its trough before climbing back. It didn't seem like the tax cuts worked in terms of stimulating consumer demand. Is that right?
Well, if you remember, the tax cuts took a while to pass.
Okay.
So there was a long process to get that through. And I think it was towards the end of the year that they finally got that done. So I don't think that has an immediate direct implication. And don't forget, that wouldn't kick in and put more money in the taxpayer's pocket until the following year when they filed and got their returns and all of that. Now, it might change expectations. It might change sentiment. It might change all of that. But the point that I'm trying to drive home is how people are thinking about the Trump administration is completely different than what actually happened in Trump 1. And the policies and the outlook and the appointments are really no different. It's the same red hat. They added one number to the side of it, and same policies, effectively the same proxies. And I think you'll see the same result, which is that it's an environment where Wall Street certainly does well, but for the first time in decades, Main Street was absolutely humming. If you remember from 2016 to 2019, the average middle-class person was feeling so much better. Small business owners, real incomes were going up. And it's that type of excitement, I think, that you're going to see start to be felt next year and for the next 3-4 years, where everyone's participating versus just the people at the top.
What's the NFIB latest small business optimism index showing right now? Do you know?
The sentiment indicators that I've looked at are just starting to turn up for the first time in the last handful of weeks or months. So I think that trend is going to persist under Trump. Even if you look at institutional managers, while they've become more enthusiastic, they're not quite at euphoric periods. If you look at the Bank of America Fund Manager Survey, they look like managers usually look coming out of deep troughs, but not yet at peak excitement, peak sentiment, peak positioning. And I think the same is true for the consumer confidence, which has been really low because of the price of groceries and different things that affect their everyday lives, is just now starting to turn in the right direction as incomes are slowly starting to catch up, and now on optimism on a renewed set of different policies.
I want to bring up one more step before we go, Thomas. Just going to get your reaction to this. This was an op-ed written by former FDIC Chair Sheila Bair. I actually had the pleasure of speaking with her this week. Anyway, this was an op-ed she wrote. CFA Institute recently surveyed over 4,000 of its members on the state of U.S. finances. Supermajority, 77%, believe the U.S. finances were on an unsustainable trajectory. A significant majority, 61%, believe that the U.S. lacks the political will to reduce its debt to GDP ratio, while 63% believed we will begin to lose our reserve currency status within the next 5 to 15 years. First of all, are you in this camp at all? And does this sentiment have any effect, long-term and or short-term effect on the bond market?
Yeah, two things. Number one, they misspelled her last name on the article. I think they have it as Bair. It should be Bear. I've watched her interviews for the last 10 years, and she's consistently bearish. So I'll leave that. Number two, you've got Elon and Vivek coming in that are doing something that hasn't been done for decades, if ever, which is they think they can cut $2 trillion of costs. Let's say they're wrong and they can only do $1 trillion of costs. Yeah. That's deflationary. There's going to be a lot of people unemployed out of government jobs as they cut down different agencies, and they cut a lot of those jobs until they get absorbed into the private sector. Then you're also going to have an issue with labor, different supply of labor than we've had in the last 4 years as the border gets closed up, and maybe some people are returned back, but certainly as the border gets closed up. So I think that we're going to see a situation where the terminal rate is higher than anticipated at 4%. And I think inflation is going to be higher than anticipated. They'll keep talking about 2% to pin inflation expectations, but they know it, you know it, I know it, everyone knows it. They've got to run inflation hotter in order to bring the debt to GDP ratio back down from 120 to a more reasonable level, like we did after World War II. From 1948 to 1956, we took it from 120 down to 53. And in those years, inflation ran between 3 to 5% pretty consistently. And you had hot nominal GDP growth, which is exactly what we're going to see under the Trump administration. We are going to see nominal GDP run at levels that we have not seen in decades. I think as you look 2 years out, I could see 4, 5, 6 handles like we haven't seen in ages. And that will do a lot to bring the ratio down based on these policies.
That's nominal GDP. What about real GDP? What about inflation adjusted? Is inflation going to catch up, you think?
I think inflation is going to be higher than 2%. I think it's going to be, I think the mean is going to be 3.3, 3.5, somewhere in that for the next 5 years. And if we do that, then debt to GDP comes down, and all the Sheila Bair articles will be solved. It's reasonable to have that fear. I mean, if you look at the numbers objectively today, people should be worried. I think that the country is worried enough that the voting electorate looked like a pizza, not blue raspberry Jello. I mean, when you looked at the map, the country went red and it swept, and it's why, because they believed that in the short term that election could get these things in order. Now we get to see if they were right, and if in fact we can get our fiscal house in order. But it certainly seems like if anyone could get it done, Elon and Vivek would be the people you'd want to tap.
Okay, so that aside, let's assume you're right. So government becomes more efficient. We'll come back to that at another time. Let's see how that plays out. But let's just address inflation before we go. So you brought up inflation going north of 2%. So this is what happened during the last Trump presidency, hovering above 2% for most of the term. There were periods when the CPI, headline CPI, was down below 2%. But I'm pointing this out because it didn't spike considerably due to Trump's protectionist policies. I'm hearing a lot of this in the media, the fear that inflation is going to go way back up because of tariffs. That didn't really happen last time.
Well, the key thing there,
now.
what's the key input cost to everything is energy.
Yeah, you're right. Energy was deflationary for some parts of the last Trump presidency.
Yeah. Yeah, and it was coming off much higher levels too. From 2011 to 2014, energy was really high in terms of price, and it was more normalized under Trump because supply increased. And he was blocked on some of the things to get supply going. If you recall, with the pipelines, with the Anwar, with the opening up the different government things, he's not going to have those type of restrictions, certainly in the first 2 years of his presidency. So there is a lot that he can get done that will be deflationary and very, very positive and very productive for the country. So all in, it's a good economic formula. I just think that if history is any prologue, from 1932 till today, continued strength after this short-term November weakness until like after Thanksgiving, into the inauguration, stock should be up. And then that 6 months, it will have to consolidate while the market figures out policy, the appointments, and everything else before resuming some strength the second half of the first year of the election cycle.
All right. Well, you heard it here first from Thomas Hayes, the Trump trade that may or may not be. So where else can we follow your work, Thomas? By the way, you can check out our last interview with Thomas, link down below. And visit some of his calls from a couple months ago. But where else can we follow you?
We have a blog, hedgefundtips.com. That's where we post all of our weekly podcast. Is called Hedge Fund Tips with Tom Hayes. It's ranked number 1 or number 2 in the hedge fund category. You can find us at YouTube. Just put in Hedge Fund Tips. X.com. You can find us at symbol Hedge Fund Tips. And TikTok is a big thing for us. At official hedge fund tips. That's been phenomenal for us. So that's the easiest. And to contact us, just do so at the website, hedgefundtips.com.
Okay. We haven't talked about TikTok, banning TikTok. We'll see if that happens. But anyway.
Yeah, it's not going to happen now under Trump because it doesn't want Zuckerberg to have a monopoly. So you will be able to do your crazy dance music there, David.
And we'll be able to follow. And we'll be able to follow hedge fund tips on TikTok without fear of getting
official hedge fund tips. That's right.
Yeah, all right. Yeah. Thanks very much, Thomas. We'll speak again soon. Take care.
Thanks, David. Appreciate it.
Thank you for watching. Don't forget to like and subscribe.